Have you ever looked at a company's financial report and just had that feeling that you're not getting the whole story? Well, you're probably right. Today, we're going to put on our detective hats and uncover the 2 secret rules of accounting that reveal what's really going on. Let's dive in. So let's start with a big one. If you see a company with $1 million sitting in the bank, that means it's doing great, right? It seems so simple, but honestly, that's not even close to the full picture. In fact, cash can be a huge liar. Okay, so check this out. Picture 2 companies. Company A is swimming in cash, but what you don't see is that it's sitting on a mountain of debt that's due tomorrow. Then you have Company B. Its bank account looks pretty empty, but it just signed massive deals and has huge payments coming in. So who's in better shape? If you're only looking at the cash, you'd bet on Company A every time, and you'd be dead wrong. So to really figure this out, we have to start thinking like financial detectives. And every great detective has their secret tools, right? Well, in accounting, those tools are 2 fundamental assumptions that completely change how you read the numbers. Let's uncover our first clue. All right, clue number 1. This is called the accrual rule, and honestly, it is a total game changer. The idea is simple but so powerful. What matters is when a business actually earns the money, not just when the cash physically shows up. Okay, so here's the official textbook definition. The accrual basis means transactions are recorded the moment they happen. Think about it. A sale happens the second the contract is signed, right? That's when the value was created, not weeks later when the check finally clears. The same goes for expenses. You record them when you use a service, not just when you pay the bill. And this chart really lays out the 2 different universes we're talking about, the accrual world versus the cash world. The cash world is misleading. It can make a company on the brink of collapse look amazing for a day just because a big payment came in. But the accrual world, it gives you a much, much truer picture of a company's health because it matches the revenues with the exact expenses that it took to generate them. So what does this do in practice? Well, it adds entire chapters that the cash-only story just leaves out. Suddenly, you can see all the money that's owed to the company. That's your accounts receivable. And you can also see all the money the company owes to others, your accounts payable and other accruals. It gives you the whole playing field, not just a snapshot of the cash in one player's pocket. Here's a perfect way to think about it. Imagine a company uses a ton of electricity in December to run its factory, but the bill doesn't show up until January. If you only look at cash, that's a January expense, but the accrual rule says nope, not so fast. The company got the benefit of that electricity in December, so it becomes a December expense. It's a much more honest way to see if the company was actually profitable that month. Okay, so we've got our first clue locked down. Let's move on to the second one. This one is all about the future. It's called the survival assumption, or what accountants call the going concern assumption, and it's all about perspective. Now, this might sound super obvious, but it's one of the absolute pillars of accounting. Basically, every financial statement is written with this one core belief. The company isn't about to go belly up. It's going to continue operating, selling things, and paying its bills like normal. And you might be wondering, what exactly is the foreseeable future? It's not just a fuzzy idea. In accounting, it's very specific. It means management has looked at everything and feels confident they can keep the doors open for at least the next 12 months. The implication of this is just massive. It means we value everything the company owns, its factories, its equipment, everything based on its usefulness to the ongoing business. A factory isn't just a pile of bricks. It's a living, value-creating asset. This assumption completely changes how we calculate a company's worth. Okay, but what happens when that's not a sure thing anymore? What if survival isn't a given? This is where things get really intense and where you see just how critical this rule really is. So let's ask that really scary question. What if a company is bleeding money or it can't pay back its loans? What if management looks ahead and can no longer say with any confidence that they'll be around in 12 months? This is where the floor can fall out from under a company's valuation. As long as the going concern assumption holds, assets are valued for their productive use. But the second that assumption is in doubt, whoa, everything changes. That factory is no longer valued as a production center. It's valued at its fire sale price, whatever you can get for it fast. And all those long-term loans, they could suddenly become due immediately. The company's value can absolutely crater. And listen, this isn't just some dusty old accounting theory. Think back to the COVID-19 crisis. All of a sudden, airlines, restaurants, hotels, thousands of businesses had to seriously ask themselves if they could make it another year. and they had to disclose these going concern uncertainties to investors, giving everyone a crystal clear warning of the risk involved.
So there you have it. Those are the two secret clues. The accrual rule, which tells you the truth about performance, and the survival assumption, which tells you the truth about the future. You are now equipped to be a financial detective, to read between the lines.
So, using your new skills, here are the red flags to watch for. If a company's reports look like they're totally ignoring unpaid bills, be suspicious. If they brag about a bright future but are suffering huge losses without explaining why they think they'll survive, you should be skeptical. These are the signs that the official story might just be a work of fiction.
So the next time you look at a financial statement, don't just get distracted by the cash. Remember these two rules. Ask yourself, is this story based on when value is actually created? And is the assumption that this company will survive really justified? Because now that you know the secret rules, you can finally start to understand the story the numbers are really trying to tell you.